So I am incredibly excited about my next guest. This is a fireside chat between myself and Rob Massey. Now, Rob Massey, I don't think he really needs an introduction. He is Deloitte's resident DGen, and we love him dearly for that. He's been in the space as long as I have. We've seen it at every one of these conferences. But because protocol, it's good. I will introduce him. Rob Massey has more than 20 years of professional experience in tax consulting for technology companies. Since 2013, he has focused on blockchain, digital assets, cryptocurrency, and tokenization. Rob leads Deloitte's blockchain efforts in tax for the global firm, serving companies throughout the blockchain ecosystem. Rob, please join me on stage. We're talking taxes. Sir.
Thank you, Pat. Very nice. Nice intro.
Oh, Rob. So we've gone deep on accounting. We had a great talk from Tony on tax earlier, which was really fun. It was good seeing the early divergence between accounting and tax. But today, right now, we get to go deep on accounting, and I'm just so thrilled on that. So, on tax, excuse me. And I'm just so thrilled at that. So where I want to start with you, because when you and I, one of the first times you and I met, one of the drums that you were banging at that time, which was super interesting, was the deep discussion in tax for crypto was about whether inventory was kept at a entire basis for your, like one inventory for your entire company, one inventory per wallet, some semblance of different combinations of that. That's becoming, it's always been an interesting topic. It will continue to be an interesting topic. It's become even more relevant now because next year when we start seeing the 1099-Bs come for the exchanges, we're suddenly going to have this terrible, and I say terrible, you don't have to, that's okay, terrible experience where I'm going to have a inventory in Coinbase, regardless of whatever I'm doing, because I get my 1099 from Coinbase, I'm going to have an inventory that gets relieved over there that's getting reported to the government. And we're suddenly in this like kind of nightmare scenario of what constitutes an inventory. So what is the current state-of-the-art thinking around this?
Great question. It's funny, and you said 2023 is the year of payments, and so it's going to be relevant this year as to where you relieve it. We, inventory is kind of a charged word in the tax world, and that is for people who really, manufacture, produce, sell goods and services. But and that's relevant with tax accounting methods, and when you're dealing with fungible assets, although we can see it moving around chain and you sort of see what's going on, because they are fungible, so let's stay away from NFTs, the intentions and the wallet structures and processes you build to make sure that you say, hey, crypto OG, right? I've got my $8 ETH sitting right here. I was there super early stage. And then those that I have earned or procured later are sitting in different addresses. That concept of being allowed to use spec ID only exists if you can really segregate fungible assets. Now I know that some would say that's an extreme point of view, and they're like, Rob, you're being too much of a low lady, and I'll take that, because there's even FAQs that the IRS has published that talks about books and records. And that should be adequate if you want to use spec ID. And when you relieve your ETH, you want to relieve those that you procured at $2,000 if you're going to spend it today and trigger a little bit of gain and loss, versus relieve those that you had at $8 basis and trigger a lot of gain today. And so we talk about segregated wallets or accounts within custodians as being important, because if it's worth a little bit of money, maybe you don't care too much. But if it's worth millions or even billions of dollars, as some of our clients, you really care about making sure you can use spec ID. If you don't have adequate segregation in books and records and you're bound by FIFO, then guess what? You're going back to that $8 basis ETH. Yeah. So, when you talk about levels of authority in this world, and there's some accountants and attorneys in the room, there's Congress and there's tax court cases, and there's code and there's regs, and there's rev rulings, and then there's notices and levels of authority. Way down here is FAQs, kind of around the realm of crypto Twitter, right? In terms of like relying on authority. And so if you have billions of dollars at stake. I get all my tax advice from crypto Twitter. Well, I mean, it's fine. It's very healthy banter, but if you really have billions of dollars at stake and you want to rely on something, go beyond the FAQs. Think about the principles we have at stake. And so think about segregated fungible assets. To be recast and bound by FIFO is pretty awful.
So what we've seen in this case, and I assume this is still some of the guidance, would be if you are an organization that gets revenue in crypto, you're going to set up some sort of receiver wallet where that revenue is going to hit.
Yep.
And then as soon as it hits that wallet, you're going to sweep it to a wallet that is representative of a price band.
100%. So like having an operational hot wallet or 2 or 4 or whatever you want to do, and then redeploy with intention to those segregated wallets, addresses, accounts, whatever you want to do, with heavy documentation, like real documentation, like actually typing in. Remember in the day when you would type into journal entry fields? So that kind of stuff to say, what are you doing? Contemporaneous documentation, this is the wallet it's going to, and then importantly, you've got the transaction, the on-chain transaction you see comports with your subledger, right? And this is where you really come into play. Having those two things work real time along with the documentation should be pretty good when you face off against an agent.
Yeah, and we'll actually be showing this off later today. We added a wallet level inventory part of our inventory views that does allow you to do either one wallet or multiple wallets.
Yep.
It's an interesting discussion. So and I'd say that is when the monetary value is such that there's real concern here about protecting yourself. That's when you want to go. That's the most conservative stance to take.
100%, and having some sort of books and records. You don't want to just say, oh, it's all on chain. That's not a great place to start with an agent or with your accountant.
We hear so much. I mean, it's like literally the one refrain you hear from every single person in the world when you get a new client in digital assets. Like, well, it's all on chain. Like, why is this hard?
Oh, sorry, we're still being counters. You got to keep books and records.
So let's talk. I want to go back. Mackenzie's talk was fantastic. Let's talk about staking a little bit. Yeah, great job. Let's take some of the stuff that she was talking about and look at it from a tax perspective. So she had 4 really, really great use cases. She had staking, where you're getting a reward that you occasionally sweep. So you accrue a reward and you sweep it. She had Aave, which is a lending where I'm borrowing money and paying interest. She had a insurance protection, which is pretty interesting, but that's depositing collateral. Let's look at each of those because I think they're all really interesting use cases around tax. So let's start with the staking at a high level. Now, this is not tax advice, obviously, and this is not accounting advice, because this is a really hard issue. Give me how you're thinking about this right now.
So staking, let's start with the premise, and not everybody's aligned on this yet, but let's say that you're going to record staking rewards as income when they're earned or received. And that's not to cast shadow on those that take different positions, because there's interesting positions that say that staking rewards are acquired property versus income when received. But let's go the income route just for the minute. And so if you're going to record staking rewards as income, and we know that the value of the rewards changes all the time, and so based on how much you're earning, right, and how often you're pulling it down, or the basis of epochs that you have secured those rewards, you may want to set up a wallet structure that allows you to house the rewards you earned on this, maybe on a daily basis, and then you would take the average price of that day, tracking to those rewards, watching that on-chain transaction to that wallet or that address, and then having that set up with your subledger system and different accounts to track, okay, this is the amount earned on this day, and that would allow you to segregate and respect the basis earned at that point. And
that's to say, that's kind of a departure from accounting in that sense, which is accounting treating those rewards. Mackenzie's recommendation was to treat it as a accrual, so you're really not, I think that the traditional definition of that would be you are not in receipt of those tokens yet. From an accounting perspective, we're saying from a tax perspective, the more conservative stance here is that you are in receipt of those tokens. They are in inventory. They are relievable.
Well, so then going to we would look to when earned, again, assuming you're going to treat them as earned income, and then going to the rev rec treatment that Mackenzie went through, and then building a process upon receipt to track what you've earned and then putting them in separate places. Now, my daily example might be a little extreme, right? But building a process which is systematic and rational that says, here's the bucket of rewards that I've earned during this period. Here's me relieving those rewards. I'm going to put them here, and then set up a cadence that is like practically appropriate given the volumes you've received. The tricky part in staking rewards, one of the many, is that your principal, particularly when we're talking about ETH, which was not one of the examples, but that is that, again, going back to your crypto OG, you may have $8 ETH that you staked. Yeah. And if you're earning those rewards today, then that's going to be in the realm of like $1,900. I didn't look this morning. Yeah. And so then when you relieve those ETH, right, when you have those withdrawals, which ones have you withdrawn?
Yeah.
And you can't pick and choose whether it was principal or the rewards that you've earned. And so you may be stuck on a FIFO basis in relieving those out of the system.
Yeah, so you use your $8 ETH to fund a bunch of validators. You start withdrawing from those validators. You're actually withdrawing $8 ETH, not the principal on top of it.
Right. If you believe that you can't pick and choose what's inside. And so this is where you got to be careful in the positions that you decide to take. Yeah. But importantly, you want to be systematic and rational. Not like you can't change your mind, but if you do change your tax accounting method, you do have to seek permission through an application process by the service. Painful. That's different than DeFi lending and different than taxes.
Yeah. So let's talk about DeFi lending, because I honestly I always myself get pretty wrapped up in lending. I get wrapped around the axle on it, because the moment that you lend money out, you are creating a short position. So there's a potential disposition there that you're taking, potentially not. If it's a short position, you might be acquiring a short position that's relative to the other person that you might have to FIFO through. Help talk me down off the ledge, because it's really hard to think about lending these assets out.
It's very difficult, and particularly if you have some that you're holding and some that you're lending. To your exactly on point, you have a short position, watch the straddle rolls. Sleeper topic, really dangerous to fall into this hole of a straddle, whereby if you recognize a loss, you may not be able to realize that for tax purposes until you completely exit the position.
Oh.
Watch the straddle rules, sleeper in there. So, but with DeFi lending, what we think about is, and a lot will analogize to SEC lending, right? Securities lending, which was codified years ago when Congress said we need to protect this, is important to the markets. We don't have an explicit safe harbor like SEC lending for crypto. It's been proposed a few times through various members of Congress and the Green Book. We don't have it today. And the analogy's not terrible. And there's tax principles that you can look even beyond the explicit safe harbor of SEC lending. You can look below that and look at the tax principles that we've used for 50, 60 years on this topic, which stand for the proposition that if you truly maintain the benefits and burdens of ownership while that asset was sitting somewhere else, then maybe it's still yours.
So that would go for like margin positions, or if I'm borrowing to short something, so the institution that is lending me a stock to then short it, they still actually have exposure to that asset potentially, or through the SEC rules.
You got to look through rehypothecation. What is the likelihood that you can get it back upon demand? A lot of the principles that lent to the SEC lending safe harbors for tax in 1058, those principles still exist. And so then you look at, can you get it back on demand? But importantly, the benefits and burdens of ownership. Do you still have it? And the difference there, obviously, is if you think it's still yours, then when you pull it down from the DeFi lending protocol, then you don't have a recognition event, right? Nothing has changed. If you don't feel good about it, then you may have a recognition event on leg one when you went in, and then again when you leg out.
Does tax law contemplate a shift in sentiment? I go from feeling very good about it to a rug pull happens here and here and here, and suddenly I don't feel so good about it, so I have to do.
Never happens.
Never had. I always feel good about crypto. That's never happened to me, but like for other people out there, I can imagine.
Yeah, I mean, does it contemplate it? Sure.
Yeah.
And facts and circumstances change all the time. Protocols go away. Custodians fail, right? We're living in an era when there's real material failures out there. And so then you look at, underlying case law, what happens when there is a rug pull, when there's fraud, when there is a Ponzi out there.
Yeah.
So there are some rules to deal with that, some not specific, but we do our best.
Yeah, it's a super interesting one. Okay, so let's talk briefly. So we got the FASB update from KPMG. Tony talked about wrapped token treatments.
Yeah.
I think everyone on our side we are all kind of grappling with this, to be honest, because it's just a nightmare scenario in a lot of ways, because it's gonna be so difficult in this particular instance to really tease these apart. Now we have support in Bitwave for it, but it still is hard. Did you agree with his assessment? Like nothing. You don't have to argue, but if you want to argue a little bit, that wouldn't be against the rules.
No,
here. But
Tony was spot on.
Yeah.
I mean, and very articulate in the way we're describing. Look, in the U.S., unless you have a recognition event for tax, then we're going to have a difference than what we have for GAAP.
Yep.
And so, tracking book tax differences is a normal thing for us. The wrapped thing is interesting, and we've been dealing with wrapped tokens for a while. When the FASB started delineating the differences between wrapped tokens and other tokens, it made everybody question again, did we get it right when we started talking about wrap tokens for tax the first time? And it's causing us to re-examine what is a lot of questions on this topic. And I'll go back to something I referenced, which is if you take your Bitcoin and you wrap it, WBTC being very popular, if you maintain all of the benefits and burdens of ownership, despite that you've added an element of utility to that piece of property, should probably be okay. Mm-hmm. But the more exotic the wrapping function becomes.
Crossing chains.
Right, crossing chains. Or if you've split the benefits and burdens to other parties in the chain, that which you didn't contemplate on leg one, you may run into a problem. Like you have a recognition event when you wrapped it, and then when you came back out.
So do you see people doing separate analysis on a token by token basis?
100%.
Okay, so that would be
100%.
wrapped ETH, looking at the functional, technical methodology here,
Yeah.
very, very solid. Let's just call that a wrapping.
You have to look at how much changed. If you get something back which is significantly different than the thing that you gave up, you may run into a problem like you had a recognition event. And so it's not just the token type, but also like the wrapping mechanism that you used, or if you like did something exotic from a smart contract perspective.
And it's funny, like the FASB is so interesting because it showed a level of sophistication. Like it really did. This idea of the fungibility and self-issued tokens and all that kind of stuff showed a level of sophistication, even contemplating wrapping. Yeah. But then it kind of did stop short in a lot of ways. We're like, but we're not going to think about this right now. And it's funny because one of the excuses that I heard, excuse is a harsh word, but was that wrapping was immaterial to the ecosystem, so it wasn't really contemplated because of that. And I took exception to that because anyone in the ecosystem has wrapped a token.
Yeah.
Everybody has wrapped a token.
100%.
So it was a really interesting part it's important for us to examine here. Okay, we got 4 minutes left here. And so there was a real recent notice that came out from the IRS. Yep. I love it because it had to do with retirement accounts of all things. Like, I don't get the IRS. I don't pretend to get the IRS. I don't get why we have a million people all trying to file their crypto taxes. They're like, well, let's talk about retirement accounts. And there's like 7 people who have retirement accounts with crypto in it. But that's not for mere mortals to say. So tell us about this, what the guidance that came out, how they're thinking about it, what's changed.
Yeah, I won't disagree with you. I don't think that this was a common topic that impacts millions of people.
Everyone was clamoring for retirement guidance.
I can't speak to why they chose it, but the significance of the notice goes well beyond the impact to retirement accounts. We've been talking about for over a decade the difference in what these different digital assets represent. And we play the silly game, what's the thing, right? We've made t-shirts to play this game. It's really important to look at what does the token represent? What is the utility it provides? Is it access? Is it a digital representation of a thing? Like, how decentralized is it? Does it have elements of equity? And what the notice did, and the notice, if you haven't read it, really gets to collectibles, which are taxed differently in retirement plans than are other types of assets, right? And why is there an exception for collectibles? You can go back and read congressional banter on this. But the point is, and this is really healthy for us, I think it's the first time that there was any guidance that came from the IRS that recognized and credentialized the digital assets are different. And they're different in different ways. And so it said, okay, good, we have some grounding here. Because before, all we had was very general statements. It was crypto this, convertible virtual currency over here, right? It was very general. And so allowing us now to say, okay, what is this thing?
Yeah, we can do an analysis.
Yeah, absolutely. We can have a difference, whether it's character or the utility, or even something like even using the collectible. What happens if, there's a concert ticket and there's a famous artist, let's say Gaga decides to tokenize her next round of tickets for a concert. And of course, I'm going to sit in front row because I got to see it. And so that ticket is going to have utility, it's going to have access day one. But what if it becomes a collectible later? And we see lots of examples now where digital assets are going to have an element of utility in the first use, but maybe it becomes something later. Very relevant to this concept of collectibles, and also other items of interest in the code and regs. Things, or even at the state level, let's talk about indirect taxes, right? We had a little banter on this yesterday. Yeah. So indirect taxes, here in the US, it's sales tax, but abroad VAT. This matters a lot if you have something that provides access versus a reference to a JPEG, a piece of art, or rights to receive a piece of property, or a piece of derivative. And the more that we bundle rights associated with NFTs, and we start to think about actual JPEGs and NFTs becoming identity if I don't want to dox myself, right? So we're watching NFTs really transform elements of commercial activities, and they may have lots of different rights. This notice allows us now to feel good when we analyze the bundle of rights differently and apply different rules and principles to each.
I love this because it's like all crypto things. It's like we peeled one layer, and that because honestly we've EDAS last year, consensus over the years, any other the ABC, the Wall Street blockchain. Bundling is not really something we talk about a lot. So we sort of peeled this first layer off as like, hey, okay, we can do an analysis. Crap. Now we have to go to the next layer and actually do a bundling analysis of, hey, we have to pay VAT on these, but we don't have to apply VAT on these. So we have to have severability within the components of a particular sale.
100%.
Yeah.
And that may or may not correlate back to going back to RevRec, what we talk about divisible performance obligations from an accounting perspective. Those rules sometimes dictate tax, but not always.
Yeah.
And so looking at it from both sides, being really thoughtful, because we've got some really cool NFT projects out there.
Oh, they're amazing.
Many of them represent different things. We just need to acknowledge it, and when it becomes big enough, do the work.
Rob, this was amazing. Thank you so very much for taking the time to chat with me.
Great conference.
Rob, Massey, Crypto OG, Deloitte DGen.
Thank you
sir.
very much. Appreciate
Thank you
it.
so much, man, for coming up.